Welcome to BFSI classes. Domain Mutual Fund Agent. Module 1 Conduct Research. Chapter Types of Mutual Fund. In this chapter, we discuss about various types of mutual fund available for investors in India. After completing this module, you will be able to list the different types of mutual fund and briefly describe various types of mutual fund. There are around 1,309 mutual fund schemes by 44 asset management companies in India. That's why they have been categorized into types in the following way, based on the structure, the investment objective, and nature of the fund. We can discuss these in detail one by one. By structure of fund, the mutual funds are classified as open-ended funds, close-ended funds, and interval funds. Both open-ended funds and close-ended funds have different investment objectives in terms of liquidity and maturity period. Take a look at the features of open-ended funds first. Open-ended funds are open for subscription throughout the year for investors. There is no fixed maturity year and they can be easily bought and sold at net asset value price. The essential feature of open-ended fund is its liquidity. They are extremely liquid, so unit capital will fluctuate. When existing investors to buy additional units or new investors buy units of the open-ended scheme, it is called a purchase transaction. It happens at a price which is equal to the net asset value. It is important to note that SEBI, that is Securities and Exchanges Board of India, has abolished entry load, that is entry charge for mutual funds, since 1st August 2009 from all mutual fund schemes. Prior to that date, the purchase transactions were happening at a price linked to the net asset value. When investors choose to return any of their units to the scheme and get back their equivalent value, it is called a repurchase transaction. This happens at a repurchase price that is linked to the net asset value. Now, take a look at the features of close-ended funds. Close-ended funds are those funds which are open for subscription only during new fund offer period. That means close-ended funds have fixed maturity period, usually between 3 months to 15 years. After initial public issue, units can be bought and sold on the stock exchange, so the unit capital will be fixed for close-ended funds. Next one, interval funds. Interval funds combine features of both open-ended and close-ended schemes. Interval funds are mostly close-ended but become open-ended at predetermined intervals. The minimum duration of interval period is 15 days. Redemption or repurchase of units is allowed only during specified transaction period. As per revised SEBI regulations, specified transaction period must be for a minimum of 2 working days. Now we move towards the second classification, that is based on investment objective. Mutual funds are classified based on the investment objective as growth funds, value funds, and fund of funds. Growth funds are those funds with the following features. Growth funds have a diversified portfolio of stocks and they are volatile, that means they have a certain level of risk. The holding period ranges from 5 to 10 years, and the main aim is capital appreciation with limited or no dividend payouts. Value funds. Value funds are equity funds which mainly hold undervalued stocks that have a high chance of paying dividends. Here, the focus is not always on stocks with low price or earning ratio. This is more likely to happen in the case of an undervalued company. Fund of funds. Fund of funds means a mutual fund invests in different mutual fund schemes in other markets. That means a mutual fund diversifies the investor amount so that the investor can enjoy the fruitfulness of many growth funds, equity funds, debt funds, etc. Now, let us look into the third classification. It is one of the broadest classification of mutual fund schemes. By nature of mutual funds, they are classified as equity funds, debt funds, balanced funds, gold funds, real estate mutual funds, and hybrid funds. Now let us look into these one by one in detail. First one, equity funds. Equity funds are those funds which invest mainly in equity holdings. The fund structure depends on the type of scheme and the fund manager's perception of different stocks. Equity funds have a number of different schemes. They are diversified equity fund, sector funds, thematic funds, equity linked savings scheme, and equity income or dividend yield schemes. Now let us look into these one by one. First one, diversified equity fund. Diversified equity fund means a mutual fund invests in diversified stocks from different companies across various categories or sectors. It reduces risk due to the diversification of assets. Diversified equity fund is further divided as large cap based, mid cap and small cap based funds. Second one, sector funds. Sector funds are those funds which invest only in security belonging to the particular sector mentioned in the offer documents. The returns are as per the sector or industry performance of the sector funds. It is more riskier than diversified funds because it does not guarantee any sure return. Thematic funds. These funds invest according to an investment theme by a mutual fund company. Investment is wider than a sector fund but narrower than a diversified equity fund. That means it ranges from diversified fund to sector funds. Equity linked savings scheme. This mutual fund offers tax benefits to investors. The investment has a 3-year lock-in period. That means an investor cannot withdraw his investment before 3 years of investment. Equity income or dividend yield schemes are those schemes which invest in securities where there is less share fluctuation and the dividend represent a bigger proportion of the share return. It is assumed that net asset value of such schemes will not fluctuate as much as other equity scheme categories. Debt funds. Debt funds are those funds with low risk as the investments are in debt instruments. They generate a stable income for investors compared to the equity funds. There are a number of schemes that fall under this type of fund. They are gilt funds, income funds, short-term plans, and liquid funds. Gilt funds means the investment is done in the Government of India securities. That means they invest in government issued securities only. They are low risk as the papers are government backed, and it has no default risk but possible interest rate risk. Income funds. Income fund invests in mix of government securities and corporate bonds and debentures. Short-term plans. These type of plans invest mainly in short-term papers like certificate of deposits and commercial papers. A sum amount of investment in corporate debentures will be made in the short-term plans. They invest in funds maturity up to 3 to 5 years, and the modified duration of the funds is 1 to 2 years. Liquid funds. It is also known as money market schemes. As name indicates, it offers easy liquidity and capital preservation. Liquid funds are those funds which invest in short-term instruments such as treasury bills, interbank call money market, commercial papers, and commercial deposits. The investment period ranges from 1 day to 3 months, and it is one of the safest mutual fund scheme which gives assured return to the investors. The fund manager has to invest the funds maturing in less than 61 days. That means minimum investment period is 61 days. Balanced funds. Balanced funds are those funds which invest in equity as well as debt funds. The main aim is to provide investors with the benefits of equity and debt. Equity provides growth and debt provides stability. Allocation between equity and debt can be fixed or flexible, and the allocation information and details of the investment style can be found in the scheme information document. The next type of fund is gold funds. Gold is one of the most important asset classes. There are two types of gold funds. They are gold exchange traded funds and gold sector funds. Gold exchange traded funds means there is no physical delivery of gold, but the fund units are backed by the gold. It is usually held in demat form, that is dematerialized form, and investors receive a security certificate that defines the gold ownership. Gold sector funds. Gold sector funds are open-ended mutual funds. They invest in gold trading companies and gold mining companies, etc. Last one, real estate investment funds. A real estate mutual fund is a mutual fund that invests in the securities of real estate companies. Real estate funds can invest in property directly or indirectly via real estate investment trust. Hybrid funds. Hybrid funds are classified as active funds and passive funds. Active funds means the fund manager can select the investment portfolio within the broad framework of the scheme's investment objective. And the fund manager has a greater role which leads to increased fund expenses, and active funds are expected to perform better than the market. Passive funds invest on the basis of a specified index whose performance is one to monitor. Each share in the scheme's portfolio is in the same proportion as the share weightage in the specified index. Passive fund performance is usually the same as the performance of the specified index. Fund manager has no role in deciding investment which leads to low running cost.